Double entry principle. Double entry principle. Good day, viewers. Welcome to Web Educate. Today we are focusing on double entry principle. This is a follow-up from our previous video on double entry principle. But today we are focusing on double entry principle as regarding asset of stock. Regarding asset of stock. Double entry principle, asset of stock. In the previous video, we show a sample on double entry principles, which does not involve asset of stock. They are just examples on assets, capital, and liability, which does not involve asset of stock. What is asset of stocks? Asset of stocks are those transactions that concern assets of a company which are not dealings, assets of companies that does not deal with that is not concerned with the goods and services that the business is dealing with. But when you say asset of stock, these are the what? These are the goods and services that the business is dealing with. When you say asset of stock, in that examples or question, you'll be seeing goods. You'll be seeing return inward, return outward. You'll be seeing purchases account, you'll be seeing sales account, return inward, return outward account, carriage inward, carriage outward account, then cash and bank account. So today we are focusing on asset of stocks under double entry principle. Under double entry principle. Double entry principles, as we have said in our previous video, are those accounting transactions whereby transactions are entered in two separate accounts. A single transactions are entered in a double on a double entry basis, where a transaction is credited and also debited in different accounts with the same amount. That is double entry principle. The transactions involve two entries in two separate accounts. One is debited and one is credited. So today we are focusing on asset of stocks, and what you'll be seeing in the asset of stocks are goods. We're seeing goods bought, goods sold, goods returns. Those are the what? Asset of stocks. That is what the business is dealing with. What the business is dealing with. Asset of stock. And today we are presenting these little questions. So write up the following transactions according to how it will be debited and credited in a columnar table or in a columnar form. In a columnar table. A. Goods bought on credit from Aru Bello. Goods bought on credit from Aru Bello. This is goods. Whenever you hear goods, what are we talking about? Goods bought. When you hear goods bought, that concerns purchases account. Goods bought. That is goods. That goods is what the business is dealing with. Goods bought. That is purchases account. It involves purchase account and Aru Bello's account. You debit purchase account and you credit Aru Bello's account. B. Goods sold on credit to J. Lawrence. Goods sold on credit to J. Lawrence. What is that? This is goods also. Goods sold. that is sales account. It involves sales account. On credit to J. Lawrence, you credit sales account and you debit J. Lawrence. J. Lawrence is the receiver. He did not pay, and that is why credit. A transaction that involves credit on credit basis is where you have sold on credit, and the name of the person have to be what? The name of the buyer have to be what? Have to be written. Goods sold on credit to J. Lawrence. That is, you credit sales account and you debit J. Lawrence account. C. Motor van bought on credit from A and A Limited. Motor van bought on credit from A and A Limited. You can see now, this is not goods bought. This is motor van. So, motor van is not asset of stock. Assuming it is asset of stock, that means the business is dealing with motor van. You will not see motor van here. What you are going to see here is what is goods bought on credit from A and A Limited. But in this case, motor van is not what the business is dealing with. So motor van is an asset. As you have it in accounting, that accounting equation is asset is equal to capital plus liability. Asset is equal to capital plus liability. Motor van bought on credit from A and A Limited. So what are the accounting entry there? Motor van account and A and A Limited account. You debit motor van account and credit A and A Limited. A and A Limited is the giver, while motor van account is the receiver. D. Goods sold, a check being received immediately. Goods sold, a check being received immediately. Goods sold, that is, it involves sales account because you say goods sold, a check being received immediately. So it involves sales account and check account, check being received immediately. That means you are debiting bank account and you are crediting sales account. I've said it in our previous video that whenever you see check, that is bank account. That is bank account. Credit sales account, debit bank account. E. Goods sold for cash. Goods sold for cash. And goods sold for cash, this is also still asset of stock because you are talking about goods sold. That is goods sold for cash. You credit sales account and you debit cash account. Goods sold for cash. You credit sales account and debit cash account. Sales account is the giver. Cash account is the receiver. F. Goods will return to Benson Limited. Goods will return to Benson Limited. This is goods will return. This is not asset of. These are not the asset of stock. Goods will return. Like I said, that asset of stock involves sales account, purchases account, return inward account, return outward account, carriage inward account, carriage outward account, bank account, cash account. As you can see, goods will return to Benson Limited. This involves return outward account and Benson account, Benson Limited account. We credit return outward account and we debit Benson Limited account. It is under asset of stock. You'll be seeing return outward, return inward. G. Goods returned to us by M.O. Teddy. Goods returned to us by M.O. Teddy. Goods returned to us by M.O. Teddy. In this case, this is return inward. Return inward. Return to us. Return to us. In the F, say return to Benson. But in this case, return to us. That means return to the business. That is return inward. So you debit return inward account and you credit M.O. Teddy's account. M.O. Teddy account. Teddy is the giver, while return inward is the receiver. H. Paytokes Limited in cash for goods bought on credit. Paytokes Limited in cash for goods bought on credit. Paytokes Limited. That means in cash. How do we pay him? We pay him in cash. That means cash. That's the cash outflow here. And who do we pay? We pay Tokes Limited. That means Tokes Limited is receiving, cash is given out. You debit Tokes Limited account and you credit cash account. And that is the interpretation of the question. Now I rub up the question to present the solution in a columnar form. That is in a columnar table, in a table form. So double entry principle, asset of stock under double entry principle. Asset of stock are those accounting method that involve some accounts like what is it? Sales account, purchases account, return inward account, return outward account, carriage inward account, carriage outward account. All those are goods. That's where you'll be seeing goods. This is double entry is what is the background of financial accounting. Every accountant or beginners in accounting must be familiar with double entry to enable him or her post some transactions in the financial statement. The double entry principle is fundamental to financial accounting. Double entry principle is fundamental to financial accounting. It's fundamental to financial accounting. So it's a bedrock of financial accounting. Double entry principle. And today we are presenting asset of stock. Asset of stocks. So I now present the solution now. Account to be debited, account to be credited, account to be credited. I present it in a columnar form. Account to be debited and account to be credited. And A, look at A, question A say, goods bought on credit from R. Bello. So write up the following transactions according to how the account will be debited and credited. Then for A, which account is to be credited and which account is to be debited. The question A says, goods bought on credit from R. Bello. Goods bought on credit from R. Bello. That is, when you bought, that is purchase account. You debit purchase account, purchases account, A/C, that is a short form of account. Then from R. Bello account. B, goods sold on credit to J. Lawrence. Goods sold, when yes sold, that is involved, goods sold, that involves sales account. To what? To J. Lawrence. J. Lawrence is receiving. Debit J. Lawrence account and credit sales account. Credit sales account. Then C, motor van bought on credit. Motor van bought on credit. When here motor van bought, that is, we bought motor van. Motor van is increasing. We debit motor van. Motor van account. bought motor van on credit from A&A Limited. A&A is the seller. We bought from A&A. A&A is giving out. A&A account. Then D, goods sold. Goods sold, a check being received immediately. Goods sold, a check being received immediately. Goods sold, that is sales account, that is goods sold. And yes, goods sold, that is sales account. You credit sales account, and you debit what? Goods sold, a check being received, that is a check being, and here check. When I have is either check or cash. When it is check, that is bank account. You debit bank account, because bank, we put the money into the bank through check. Through check. Bank account. Then E says goods sold for cash. That involves goods sold, that is sales account also. You credit sales account, and you debit goods sold for cash. Debit cash account. The money goes into our cash. That is cash received. And sales give out. Sales account give out, cash account received. F, goods will return to Benson Limited. This is asset of stocks. Goods returned. Asset of stock. When you hear goods, when you hear returns, when you hear goods bought, goods sold, goods returns, goods returned to, goods returns from. Those are the what? Asset of stock. This question says goods will return. The business return goods to Benson Limited. That means you credit return outward. The space return outward. The space is not big. We have to manage it. Return outward account. Then Benson Limited account, return it to Benson Limited account. Debit Benson Limited. Debit Benson Limited account. Debit Benson Limited account. Next, G, goods returned to us by Teddy. Goods returned to us by Teddy. Goods returned to us by Teddy. That is, it involves return in what account. Teddy gives out. Teddy account. Then return in what received. Return inward. Returns inward account. Returns inward account. Returns inward account. F, G, H. H say machinery sold for cash. H, A, B, C, D, E, F, G. Machinery. G say machinery sold for cash. Machinery sold for cash. Machinery sold for cash. I think that should be an omission. The G there, E, F, G, A, B, C, D, E, F. The G there. A, B, C, D. D is a bank account. E is a cash account. F will return to Benson. F, then G. The G there. G there is a machinery sold for cash. Okay, there's an error there. There's an error there. There's an error there. There's an omission in the question. I just manage it. There's an omission in the question. The G there is a machinery sold for cash. Machinery sold for cash. That is, machinery is given out. This is not goods. This is machinery. Then you credit machinery. Machinery account. Then so for cash, you debit cash account. See, this G is omitted, but I read it. See, machinery sold for cash. So machinery is given out. This is not sales account. This machinery sold for cash. This does not involve sales because it is not goods. Assuming it is goods, so that means it involves sales account. But machinery sold for cash. So you credit machinery account and you debit cash account. Then H, good returned to us by Teddy. Teddy is given out. Teddy account is given out. Teddy account and return. This is now returns inward. Returns inward account. Returns inward account. Returns inward account. This is asset of stock. Returns inward. Say goods returned to us by Teddy. Then I, this is I now. I says Paytox Limited for goods bought on credit. Paytox Limited for goods bought on credit. Paytox Limited for goods bought on credit. That is, we pay Tox. Tox Limited is receiving. Tox Limited is receiving. Tox Limited account. Then, for goods bought on credit for cash. Paytox Limited in cash for goods bought on credit. That is, we use cash to pay. Cash account gives out. Cash account. Cash account. Cash account gives out. And that is the end of the question. That's the end of the question. If you have been enjoying the lecture, you have derived some value, do give us a thumb up and hit the subscribe button, the red button, so that YouTube will be able to notify you when more of this is provided in the future. And you will be helping us also. That means you are supporting us to have a wider coverage of more students all over the world. Do subscribe to us so that we too will be able to provide more of this in the future. We'll be encouraged by subscribing so that I can have a wider coverage of more students all over the world. God bless you as you do so. See you in the next video.